Dear students, from the last two sessions, we have identified the concepts of not-for-profit organizations. We identified various peculiar characteristics of not-for-profit organizations. We identified that these institutions are formed for providing services to the society. They are not making any profit. They are not doing any business or any trading or manufacturing activities. And we identified from among the characteristics of these institutions, they have to comply with the legal requirements of the government. And in order to comply with the legal obligations, these institutions have to submit various financial statements to the registrar of societies. And from the last session, we identified some important financial statements that these institutions are preparing during their accounting period. It includes receipts and payments account, income and expenditure account, and a balance sheet. In the last session, we discussed about receipts and payments account, and we identified that the receipts and payments account is actually similar to the cash book of a profit-making organization. And it records all the cash receipts and cash payments of a particular period. Now in this session, we are going to discuss about another financial statement that these institutions are preparing, which is known as the income and expenditure account. So let's start the session.
Income and expenditure account. It is a final account like P&L account, which shows classified summary of revenue and expenses for current period along with surplus or deficit. So the income and expenditure account of a non-profit organization is that of similar to a P&L account of a business organization. An income and expenditure account is a nominal account prepared by not-for-profit organizations to ascertain the surplus or deficit by entering items of revenue nature of a particular accounting period. It contains only revenue items for a particular accounting period, and it is prepared to find out the surplus or deficit incurred by these institutions for a particular accounting period. Features of income and expenditure account are: it is a nominal account. It only records revenue items. That means revenue, incomes and expenses are recorded in this account. Transactions related with assets are not recorded in this account. No opening or closing balances. Income and expenditure account doesn't have an opening balance or a closing balance. The difference between the items on the debit side and credit side, that means there will be either surplus or deficit, and that surplus or deficit will be adjusted with the capital fund in the balance sheet. If it is surplus, that surplus will be added with the capital fund, and if there is deficit, and that deficit will be deducted from the capital fund. Then revenue items only. It records only revenue items. Both income and expense in revenue nature are recorded here. Capital items are excluded. Current year only. Income and expenditure of current period is recorded. In receipts and payments account, it records all the items, all the transactions, irrespective of its period of occurrence. Whether it is a past transaction or a future transactions, in receipts and payments account, we have to record all the transactions. But in the case of income and expenditure account, it only takes current year transactions or the transactions of the period in which this account is preparing. then provisions are to be made. Since this account only includes current year items, the provisions regarding outstanding expenses, accrued income, depreciation, bad debts, etc. should be shown in this account. Adjustments regarding depreciation, bad debts, income earned but not received, expenses incurred but not paid, such kind of adjustments should be made on income and expenditure account in order to get the current year value. We have to make necessary adjustments regarding these items. This is the performer of a income and expenditure account of an NPO. In the debit side, we can see the revenue expenses, which includes materials, honorarium paid for a particular service rendered, and salaries and wages, repairs, then entertainment expenses, postage, rent paid, municipal taxes, insurance premium payment. And if there is any loss on sale of asset, when a particular asset is sold, if there is profit or loss on that sales, that portion of profit or loss should be shown in the income and expenditure account. So if there is loss on sale of asset, that should be shown in the debit side or on the expenditure side of income and expenditure account. And if there is profit on sale of that asset, that profit portion, only that profit portion should be shown on the credit side or the income side of the income and expenditure account. And at last, when we balance this account, if the credit side is heavier than the debit side, then we will get the surplus on the debit side, and that will be the situation of excess of income over expenditure. And at the same time, if the debit side is heavier than the credit side, then we will get the closing balance or the balance at the end on the credit side, and that will be the amount of deficit. It is the situation of excess of expenditure over income. So in this income and expenditure account, we only record revenue nature items. Then coming to the steps in the preparation of income and expenditure account, unlike in the case of receipts and payments account, here we have to omit the opening or closing balances of cash and the bank. In the second step, identify revenue expenses. So in order to record in the income and expenditure account, we have to take only the revenue items. So first of all, revenue expenses for the current year are to be identified from the credit side of the receipts and payments account. The revenue expenses can be taken from the credit side of the receipts and payments account. Then third one, in the third step, identify revenue incomes only. Revenue incomes of the current year are to be identified from the debit side of receipts and payments account. So we will get the revenue incomes from the debit side of the receipts and payments account or from the receipt side of the receipts and payments account. So in order to take the revenue items, we have to take it from the receipts and payments account. From the debit side of the receipts and payments account, we will get the revenue incomes, and from the credit side of the revenue items we will get from the credit side of the income and expenditure account the revenue expenses. And in the fourth steps, we have to make necessary adjustments. Adjustments should be made for accrued income and for income received in advance. There will be outstanding salaries, outstanding wages like items, then income earned but not received, then income received in advance, that kind of adjustments regarding bad debts, depreciation, etc. That kind of adjustments will be there, and that adjustment should be made in the income and expenditure account. Then an important point you have to remember is about a separate trading account. It arises if an NPO carries on trading activities or any manufacturing activities. In such a situation, we need to prepare a separate trading account for that NPO. Normally we are preparing receipts and payments account, income and expenditure account, and a balance sheet. But if there is a trading activity occurs for that NPO, if any manufacturing is done by that NPO, in such a situation we have to prepare a separate trading account. Then the sixth step, make provisions. Provisions are like provision for bad debts, depreciation, etc. That kind of provisions should be made in the income and expenditure account. In the seventh step, we have to make balance of this income and expenditure account. And when we balancing the income and expenditure account, if there is surplus, that is a situation of excess of income over expenditure, that means the credit side is higher than the debit side, and that surplus should be added to the capital fund. On the other hand, if there is deficit, that is the situation of excess of expenditure over income, in such a situation the debit side of the income and expenditure account will be higher than the credit side, and that amount of deficit should be deducted from the capital fund. So the preparation of income and expenditure account will give either surplus or in deficit incurred by these institutions during that particular accounting period, and that surplus or deficit should be adjusted with the capital fund. So this is the performance of recording the revenue items or taking the revenue items from the receipts and payments account to record it on the income and expenditure account. All revenue receipts from the receipts and payments account will be recorded on the credit side or the income side of the income and expenditure account, and all the payments in the receipts and payments account from that receipts and payments account, from that payment, take the revenue payments and record it on the debit side or the expenditure side of the income and expenditure account. Now we come to the differences between receipts and payments account and income and expenditure account. As we discussed in the earlier sessions, the receipts and payments account is a real account. It relates with transactions of assets. But income and expenditure account is a nominal account. Only revenue items are expenses and incomes are taken here. And in receipts and payments account, it includes both capital and revenue items. Income and expenditure account includes only revenue items. Receipts and payments account is like a cash book of a business organization, but the income and expenditure account at the same time it is similar to the profit and loss account of a business organization. In receipts and payments account, receipts are shown on the debit side and the payments are shown on the credit side. In income and expenditure account, expenses are shown on the debit side and the incomes are shown on the credit side. Receipts and payments account is prepared on cash basis. That means if there is any cash inflow or cash outflow occurred, and that will be recorded in the receipts and payments account. But income and expenditure account prepared on accrual basis. Accrual basis means items relating to current period. If it happens on the previous period, happened on the previous period, or it happens on the next period or the next year, that should also be adjusted in the current period also. So in such a situation, that situation is known as accrual basis of recording transactions. Then receipts and payments account includes items relating to previous, current and future periods. But income and expenditure account includes items of current year only. The closing balance represents cash in hand or cash at bank or both. The closing balance that we get from the receipts and payments account, it shows the cash or bank at the closing date, the balance of cash or bank at the closing date of that accounting period of that not-for-profit organization. But the income and expenditure account, the closing balance represents either surplus or. Now we come to the treatment of some special items or some peculiar items, how these items are to be recorded in the income and expenditure account. That is what we are going to discuss. First one is entrance fees. Entrance fees is nothing but the amount of fees collected on the admission of members. And the treatment of entrance fees is like, if nothing is specifically mentioned, it is better to treat it as an income and credit it to income and expenditure account. Second one is subscription. Amount collected from members periodically is called subscription. This is shown on the credit side of the income and expenditure account. Adjustments should be made to show the correct income for the period. There will be adjustments to get the correct amount, the actual amount that should be recorded in the income and expenditure account. In order to find out that actual income, some adjustments are to be made. Then if it is a specific subscription, that is subscription received for certain specific purpose, these specific subscriptions should be capitalized. That is, it should be shown on the liability side of the balance sheet. If it is subscription, it should be treated as income. If it is specific subscription, it should be capitalized. Then donations. Donation is amount received from a person or a firm or a company by the way of gift. And the donation has two parts, general donation and a specific donation. If it is a general donation, these are not collected for any specific purpose. It should be treated as revenue income and credited to income and expenditure account. And if it is specific donations, if the donations are for a specific purpose, it must be treated as capital receipt and should be shown on the liabilities side of the balance sheet. The expenditure incurred on this account should be deducted and the balance should be shown until it is completely used up. Legacy. Legacy is nothing but an amount which is received by a not-for-profit organization as per the will of a deceased person. And the legacy, it's a capital receipt and is shown on the liability side of the balance sheet. Normally, we record it as a capital receipt, but if the amount is small, it may be treated as income and shown on the credit side of the income and expenditure account. And the important point is that if nothing is mentioned or specified about legacy, it is better to capitalize the same legacy. Then grant is the amount that is received by these not-for-profit organizations from central, state or any governmental bodies. And like subscription, this is also two type of grants, general grant and specific grant. If it is general grant, treat it as income and credited to income and expenditure account. If it is specific grant, should be capitalize it. Then another peculiar item is life membership fees. Lump sum payment made as subscription on admission of a member for the whole life instead of paying regular periodic subscriptions. That is what life membership fees. Instead of paying a regular periodic payments, a lump sum amount is paid for the whole life of membership. That amount is known as life membership fees. And about life membership fees, treat it as capital receipt and should be added to the capital fund. Then about sale of old assets, this is the amount that is realized from the sale of old assets of these NPOs. An amount which is received from the sale of assets should be treated as capital receipt and should be credited to asset account. And the important point while dealing with sale of asset is profit or loss on sale of asset should be treated as revenue and is taken to income and expenditure account. If there is profit, that profit on sale of asset should be recorded in the income and expenditure account, and if there is loss from the sale of that asset occurs, that loss should be recorded in the income and expenditure account also. Then sale of newspapers, journals, sports materials, etc. It should be treated as income and is credited to income and expenditure account. Expenditure stock items. It means items like stationery, sports materials like bats, balls, etc. are called expenditure on stock items. To make the adjustment of expenditure stock items, the value of that type of items which remains unused should be deducted from the total amount spent, so that only the amount actually used up is debited to income and expenditure account. In this situation, the closing balance of the stock items will be shown in the balance sheet, and the amount actually used, that will be debited to the income and expenditure account. Then guest fees. Amount charged from guests enjoying the facilities of clubs or such other institutions temporarily. If a particular guest arrives and that guest uses any amount, any facility for a short period of time, and the payment made for that facility by that guest is known as guest fees, and guest fees is treated as a revenue income and it should be credited to income and expenditure account. The endowment fund is nothing but the fund meant for providing permanent means of support. Endowment fund is a capital receipt. It should be adjusted with the capital fund. Then sale of scrap, grass, etc. It is like sale of old newspapers, sale of waste, scrap, etc. These items are a small amount and they are not considered as an asset, so it is to be treated as revenue receipts and credited to income and expenditure account. Then honorarium. Honorarium is the amount paid to a person for the specific service rendered by him. For example, in this case of a music club or arts club, if there is a music show conducts and a playback singer comes to sing in that music event, the amount paid to that playback singer for that particular service rendered, and that amount is known as honorarium. And honorarium are revenue expenses, and it should be debited to income and expenditure account. Then special purpose fund, that's an important item. Special purpose fund. About the treatment of special purpose fund, if there is any special purpose fund like tournament fund, charity fund, prize fund, endowment fund, etc., and there are certain items of expenses and incomes relating to that fund, then incomes and expenses should not be shown in the income and expenditure account, but income should be added to the fund and expenses should be deducted from such fund on the liability side of the balance sheet. Thus, special purpose fund, that means any fund which is used for a particular purpose only, and that funds, if a particular fund is transferred or if a particular fund is using for a specific purpose like conducting a tournament or providing charity or that kind of activities, these funds can be used for only that purposes. And if there is any incomes or expenses happens or occurs with these special purpose fund in the particular period, such incomes or expenses should not be shown in the income and expenditure account. It should be added or deducted. That means it should be adjusted with the concerned special purpose fund in the balance sheet, in the liability side of the balance sheet. Now we come to the another important thing, that is the balance sheet. And about the balance sheet, it is prepared in the same manner and with the same objective as that of a business organization. The balance sheet is prepared for the NPOs is similar to the balance sheet of a business organization to know the financial position of the institution on a particular date. About the preparation of balance sheet, the first one, ascertainment of capital fund. So in order to prepare the balance sheet, first we have to ascertain the amount of capital fund. Capital fund as the beginning is ascertained by preparing an opening balance sheet, take the liabilities on one side and assets on the other side. The difference between the two sides is capital fund. In order to ascertain the capital fund, we have to prepare an opening balance sheet. Items related to the beginning date or the opening date should be recorded on the either on the asset side or the liability side of that opening balance sheet. And when we balance this opening balance sheet, the balancing figure, that will be the amount of capital fund. Then the second step is treatment of surplus or deficit. Surplus in the income and expenditure account is added to the capital fund and deficit should be deducted. When we balance the income and expenditure account, it will show either a surplus or deficit. If it is deficit, it will be added to the capital fund, adjusted against the capital fund. If it is deficit, it will be deducted from the capital fund. If it is surplus, it will be added to the capital fund. Also, add items to be capitalized along with the capital fund. If there may be chances for getting some items that is required to capitalize. If there are such kind of items to be capitalized, that item should also be adjusted with the capital fund. Then treatment of fixed assets. Take all the fixed assets which already exist in the books at the beginning of the year. That means you will get it from the opening balance sheet and be adjusted for additions. That means if there is any purchase, that should be adjusted, that should be added with the fixed asset. And if there is any disposals, that means if there is any sale during the period, that should be deducted from that concerned fixed asset. And also make the adjustment of depreciation if any. The resultant figure will be the value of fixed asset of that. Fourth point, compare items on the receipt side of receipts and payments account with the income side of income and expenditure account. After recording the above items, then we have to compare the items on the receipt side of the receipts and payments account with the income side of income and expenditure account. And this comparison will give us the following items that should be recorded in the balance sheet. The first one is subscriptions due but not yet received. It is an asset, it should be recorded on the asset side. Then income received in advance. If any advanced income received, that is a liability. It should be recorded on the liability side. Then sale of fixed assets during the year. If there is any sale occurs about the fixed asset, that sale of fixed assets should be adjusted with the asset, and that sale will be information regarding that sale of fixed asset will be getting from the receipt side of receipts and payments account. And items to be capitalized, that means there may be some items that should be capitalized, and that items can be taken from the receipt side of the receipts and payments account. Take it to the balance sheet directly and added with the capital fund. So while comparing the receipt side of receipts and payments account and the income side of income and expenditure account, these items will be taken in order to record it to the balance sheet. Then compare, the last point is that compare items on the payment side of income and expenditure account with the expenditure side of income and expenditure account. Comparison of items on the payment side of receipts and payments account with the income and expenditure accounts expenditure side. And when we compare these two sides, we will get following items that are to be recorded in the balance sheet. The first one is outstanding expenses. Expenses incurred not paid, that's a liability. Then prepaid expenses, if any expenses, amount of any expenses that is paid in advance, that is an asset, that should be recorded on the asset side of the balance sheet. Then purchase of fixed assets during the year. Purchase of assets during the year, that should be adjusted with the fixed assets in the balance sheet. Then depreciation on fixed assets, that should be adjusted with assets. The depreciation of concerned asset, that depreciation amount will be deducted from that concerned asset in the balance sheet. Then stock of consumables. If there is any closing stock related with the consumables, that closing stock should be shown in the balance sheet. Then closing balance of cash in hand or cash at bank. The closing balance of cash in hand or cash at bank, that will be taken from the receipts and payments account, that should also be shown in the balance sheet. In this way, we can prepare the balance sheet.
So dear students, today's session is we completed all the theoretical concepts related with the not-for-profit organizations. We identified the various accounts that these institutions are to be prepared to submit to the registrar of societies. We identified three major important accounts, which includes receipts and payments account, income and expenditure account, and a balance sheet. And from the next session onwards, we'll start doing the problems related with accounting treatments of not-for-profit organization. So let's conclude here. Thank you.